everyone, welcome back to the 2310 investment video cast with me, Khalid Maidan, and I'm delighted to be joined tonight by an expert in the field of mortgages and finance, and that is Michael Webb. Michael is the owner and managing director of Mortgage Republic, which is a whole of market mortgage brokering firm based in Suffolk in the UK. And he's going to be talking to us tonight about finance and challenges that investors face in obtaining finance and using finance correctly in order to invest in the properties that they want to add to their portfolio. And we're going to also talk about a very exciting new book that Michael has released in the last 2 weeks and is already getting some good sales as people want to know more about finance. So good evening, Michael.
Good evening, Khalid. How are you?
I'm very well, thank you. How are you?
Yes, very well, thank you. Thank you for inviting me on. Looking forward to our chat this evening.
Thank you very much. It's a pleasure to have you on, and thank you very much for taking the time to come on in. So in a bit, we're going to talk about your new book, which is the Property Investors Finance Manifesto. As we said, it's all to do with finance in a second. But first, I was hoping to pick your brains on some topics that I'm sure a lot of investors have with regards to obtaining finance for their property development. So the first one I wanted to ask you is, what are the biggest challenges in financing that investors are facing currently?
The market's changing quite a lot all the time. It's a very fluid market, the buy-to-let mortgages. But I would say at the moment, the biggest challenge the investors we're working with and other kind of brokers that we know across the UK are facing is the valuations on properties, particularly when it comes to refinances. Obviously, if you're having valuation issues on purchase, that can sometimes play in your favour if you've got a vendor who's going to be sensible and negotiate slightly with you. But if you're looking at strong values on your refinances, we're seeing a reluctance from chartered surveyors to put their name to a strong valuation in this marketplace, for sure. We heard a few lenders now kind of unofficially quote that they believe surveyors are pricing in a no-deal Brexit already for a bit of kind of protection for themselves. Certain lenders are getting so many down valuations, major lenders, so people like NatWest, for example, have withdrawn their appeals process for down valuations because they were just getting such a high volume that they couldn't administer it. There's also now a declaration that we have to give to clients via certain lenders that states that their valuation is for their purpose, and if when you come back to remortgage you're in negative equity, that's your problem, not theirs. So yeah, there's lots of things that valuations are causing an issue with. The other thing to consider with the valuations, if they're not as strong as we're thinking, is if you purchased maybe a couple of years ago and the market's been stagnant in price based on your refinance from a couple of years ago maybe, and you were at 75% loan to value and you added a product fee to the mortgage of say 1.5%, very typical kind of fee. If the property price hasn't gone up and you're on an interest-only mortgage, you're no longer at 75% loan to value, and you're either unable to take a new product or you need to go onto an 80% product, which will obviously then have an element of interest rate cost for you, or alternatively you need to pay that fee down in cash sums as an overpayment to bring you back to 75%. So we've seen very recently some issues with this. So yeah, there's that kind of general issue. Obviously, values are still quite high compared to the rental yields in some areas. So people who are wanting to buy in maybe the more affluent areas, definitely the southeast, are seeing that the rental calculations don't match as the lenders would like. in a sense, trying to overcome this. Some of the lenders are allowing something called top slicing now, quite a few of them, where they'll allow an element of your own income to top up the rental to allow that to fit. And generally, the other kind of challenges on the market are that buy-to-let interest rates are creeping up. There's not big changes, but they are starting to creep up. And again, that could just be lenders trying to negate a bit of risk, and in some cases maybe take a bit more margin. I mean, they're businesses in themselves. They're there to take some margin and make some money. So where they feel they can creep those rates up, they will do.
Interesting, really interesting stuff there. And I know that the down valuations is something that you and I have had a lot of discussion with. So just to confirm for maybe some people who are not familiar with this idea, there's lots of investors out there who look to purchase a property in its worst state because it needs a lot of work. They then do a full refurb on the property to add value, and then they rely on the new value, the high value, after they've done their refurb, to be able to almost pay for the majority of the project, so that when they get a new mortgage on the higher valuation, they actually receive a little bit of money back to themselves because they have extra borrowing. But as you've said a second ago, the difficulty with the down valuations on the higher end of things, when you come to do your evaluation and the surveyors are not happy to value it as high as we had perhaps thought, is that it can put people in a very tricky position, can't it?
Yeah, so there's a few things that can kind of happen there, especially if you've financed the refurbishment, or you've got external investors, for example, that have come on board as JV partners to fund the investment, or you've taken that outside finance at much higher rates, say 10% for a year, that kind of thing. There's a danger that if you don't achieve the valuation that you're expecting, you're going to be unable to pay that money back. Couple of consequences of that: if it's your own debt on your credit cards, obviously you may then start paying much higher interest rates on it and affecting your own credit file. If it's JV investors, then obviously your credibility within that kind of sphere is going to be hit really hard if you're not paying them back as kind of contracted. And you also have the issue of if you've given them charges over properties and things like that as security, that can get very, very interesting for individuals. We've seen some quite horrendous down valuations. I mean, we've seen some, for example, where the investor thinks it's 85 and they've come in at 80, and that's probably about right. There's no arguing it. I've had one recently, there's a couple of examples that really stand out recently. One where a property in the same postcode sold 11 months ago for 79,000, was an end terrace. This was a mid terrace in new build condition, so we put it in at 75 and the valuers came back at 60 and would not budge. 20% down valuation, and they recognised the value of the other property and they just said it's not a comparable, and they wouldn't budge. And we've had another situation, a commercial development, a block of flats, 5 flats in the block, and basically the very basic valuation should have been 500,000. The commercial surveyors on the entry to this deal said somewhere between 5 and 6, and the highest valuation that we could get a residential remortgage surveyor to agree was 385, which was less than the purchase and refurb costs. So yeah, and there's no appealing these. And what we're finding is, whilst we can go to different lenders, and strangely you sometimes do get different results, and it's very much worth trying that.
Sure.
Other times you end up with the exact same human being going out to your property, and they just say, I was here last week, it hasn't changed, this is the number, but nice try.
Absolutely. And there are lots of companies there where the lender the lender doesn't have their own valuer to do it. They send a company surveyor to do that. And as you said, that's the way. So that's a really big topic. So yes, go on.
Just to explain that, all lenders will operate a panel of surveyors. There's major surveying firms in the UK. So your really big firms are the likes of LSL, Countrywide and Connells. They're your three really big ones. You've got the one that Halifax uses, that kind of their name is beyond me at the moment. I can't remember it. They're very big as well, obviously, because Halifax are the largest Lloyds banking group, largest lender in the UK. They do all of theirs. But what will happen is if Connells, for example, don't have representation in that postcode area themselves, they will panel it to a local surveyor. So that will happen a lot. So it might be one surveyor or two surveyors that are managing one whole postcode area for whatever lender, because they're the only ones that are registered with the lenders in those areas. And yes, we're seeing some fairly meaty down valuations, some very harsh down valuations, some that should be argued, should be overturned, but the surveyors aren't willing to put their kind of professional indemnity on risk at the moment, based on the wider economics that are going on. And I think until we get a Brexit solution and we get maybe into 2020 with some stability, then we might start to see them be a bit more comfortable with agreeing some of the more ambitious valuations that we're putting out there.
Absolutely. And just, I think it's important for people to understand that process of what you just mentioned about their public liability insurance. Can you just mention for a second, or perhaps clarify that if this is correct, that when a surveyor does a valuation for the lender, they're effectively giving their professional opinion. And if the property then goes into, let's say, a repossession, or as you say, valuations change because of Brexit, then the lender's going to blame the surveyor for that situation, or at least they will certainly be giving them a stern word and asking why it was done. Is there any?
To some extent, yes. So basically, the surveyor is the professional, the qualified individual to value property. Estate agents in the UK do not have the qualifications to value property. They will give you a marketing price in real legal speak. So they don't do valuations in that sense. A RICS chartered surveyor will, and the lender will instruct them to value, and they're not valuing for either you, the buyer, or you, the owner. They're valuing for the lender, and they are putting their name to that value. Now, what happened through the credit crunch was obviously surveyors were signing off values, particularly on new builds for sure, at ridiculous values that had no comparables in the resale market. They were saying, oh, well, everything on the site sold for this, so they're our comparables, but there were no resale examples. So as all these properties got repossessed in negative equity, what the lenders then did is claim their losses against the surveyor's insurance because they didn't actually back up their opinion with actual comparables. So surveyors are very, very conscious of this at the moment. I wouldn't be surprised, whilst I have no evidence of this, it's just a feeling, having been in this market now for 15 years, that certain surveying companies, especially the big ones who got hit really hard 10 years ago, might have put a remit out to their employees that they need to be cautious on their values. And unless there is nailed on comparables, and lots of them, that they go very cautious on their values, and hence you end up with 20% down valuations in some areas.
Absolutely. No, that makes absolute complete sense, Michael. So the next question I was going to ask you is about mistakes that investors can learn from. So what are the biggest mistakes that you're seeing investors do that makes obtaining finance more difficult for them?
Well, I think we've just touched on maybe the first one. So going into deals with overinflated expectations on your exit is really, really dangerous. If we were having this conversation in 2013, 2014, 6 months could cure that for you. That was how fast the market was rising. Now, I see a lot of people who are maybe sourcing deals and not doing their due diligence. They're kind of expecting the sourcer to have done that and to be maybe honest or a bit more professional or knowledgeable than they will be in the area, and they're going off for quite inflated prices. So that's a really big problem for people. The other thing that I would say that we see sometimes is people not strictly managing their credit files. So where you are looking to grow a property business, you're looking to obtain finance regularly, you're going to be applying for finance regularly, be that bridging or remortgages or using your credit cards or whatever, your credit file is going to be very active. So therefore, finance is the lifeblood of your business. Yeah. And by not really managing your credit file, you can either turn that tap off for yourself if you're really bad at managing it, or actually you can eat into your profit margin by having to obtain rates that are higher than what you would like to actually obtain. Some of the really silly things that we see are, I don't think people realise that their public utilities are on their credit file. So if they miss their council tax, their gas, electricity, if they're paying them monthly, that will go against them. This is very particular if you're running HMOs and you're paying those bills. I still see people, and I cannot work out why, people still paying their actual bill over the counter. It's 2019, set up a direct debit and make it get paid. Set up, we see it very common with credit cards as well. A very, very common mistake, not just for investors, across the board with people, is they'll pay their credit card bill over the counter in their bank rather than having the minimum payment set up as a direct debit so that it's always paid. But then go on holiday for 2 weeks, the bill will come and it will be overdue whilst they're out of the country, and therefore there's a missed payment on their credit file. And this happens so much, and people, our advice to people, always set up direct debits, even if it's just to pay the minimum payment, and then you can pay the rest off using internet banking, or if you really like going into a bank on a Saturday morning, do that. But there's things in place that you shouldn't be missing payments. And a lot of the mistakes actually we see are from people not, it's lack of attention to those details rather than inability to pay the bill.
Sure.
There's big differences there. There's an inability to pay the bill. That's a different problem to poor business management of your finances. And the latter, we see quite a blasé attitude to sometimes from people. One of the other things, I know a lot of people who we deal with, maybe a lot of people that you kind of associate with within the property business would have been taught, is to use your unsecured credit facilities, particularly your credit cards, to basically fund everything as much as you can. One of the things that I've spoken to investors about is getting a BA credit card or whatever, so you get your air miles and all of this and you stick everything on this credit card. That's great, but what you need to understand is your credit file and lenders are going to look at your unsecured debt to income ratio. So if you have, as many quite successful investors do, a low demonstrable income because they're either retaining the profit within their business or they've gone part-time in their job now, or however they're structuring it, and you've got very high debt, expect to start getting some declines from the very cheap or the cheaper buy-to-let lenders because they're the most risk adverse. And we see people with credit card debt at 3 times their annual income, and lenders are just like, we're not having that, thanks. Most lenders start getting nervous about 20 to 25% debt compared to your income. At 50%, quite a few will decline, and quite a few lenders will say, well, actually, we'll proceed, but we want to see the credit cards paid off. You've demonstrated you've got the money in the bank, as a lot of people have, but they'd rather use the credit and keep their liquid cash available. We want to see them paid off, and this is quite frequent, and I'm under no illusions that it gets paid off and 3 months later it's back again. But just be aware of utilising too much unsecured credit. Also, just to kind of outline a little bit about that, we do speak to people who are told they can use their credit card for a deposit. It's not 2008. People actually check where your deposit comes from now. They're told to draw it down on their credit card at interest-free, stick it in their bank for 3 months, and the lender won't know and just tell them it's your savings. At best, you're going to just get declined. At worst, that's mortgage fraud, and you'll end up on Hunter. So be aware of that. But the reality is a lender will want to find out the origin of the funds. So if it's savings, we've been asked for buy-to-let applications for people who they really didn't believe could save this money for 3 to 4 years bank statements. Now, that's a lot of paperwork to stamp and sign every page. These individuals had saved the money and demonstrated the balance going up and the transfer, but there's no limit to what the lender can ask for. It's their obligation to kind of determine the origin of the funds and make sure that they're covering those money laundering regulations. There are ways, and you've mentioned my book, we go into it a little bit in the book, that where you can finance at 100%, and we discuss in the book ways that can be done. So I'd recommend anyone that is considering doing that to check that out. I will tell you right now, if you're a first-time landlord, first-time buyer, forget it. It is for experienced people who have a portfolio and can back up a track record, really. These lenders aren't looking at kind of your first dip into the market, lending you 100% of your purchase price because it's at a discount. And a lot of it needs to be backed up as to why is there that discount, because again, that's a money laundering red flag for most lenders. And lastly, a lot of people want to maybe run before they can walk. Sure. And they start to take on a bit too much too soon, and lenders can get a little bit nervous with that. Even if you've got good income, you're a homeowner, all the deposits are your own, sometimes if you're trying to buy a bit too quickly, some of them want to see them let and tenanted for a few months, and that you've actually got that cash flow coming in, and that they're not kind of lending you what can end up being 10, 20 times your actual earned income with a hope that you'll get them tenanted. So yeah, a business plan and strategy, I'd always recommend sit down with your mortgage broker, have a little look at your plan out your kind of next year, 18 months of purchases when you're looking to buy, and yeah, go from there. Obviously, if you're a bit more experienced, you've got a portfolio. We've dealt with people who have bought 20 properties this year already and have had no issue buying at all, because their portfolio and everything would fund that debt, whether it was tenanted or not. But if you're buying your first one, you've got to kind of maybe take a step back and say, well, would I, if it was my money, would I give it to someone to buy 10 at once, or 10 very, very quickly? So you kind of need to build the momentum for sure, and maybe have a year to 18 month plan to go from 0 to 5 to 10 properties if you're financially able to do that. And also that people shouldn't be pressured into thinking that you're only successful if you've got 10 properties. Some of the most successful landlords we work with still only have 3 or 4 properties, but make fantastic money from them. Very low voids, very low maintenance and issues with them, no stress, and do a lot better than people with 5 times as many who are pulling their hair out trying to manage the properties.
Absolutely. No, that makes total sense. And I think one of the key themes from all the things that you've said there, whether it be the unsecured lending, whether it be the down valuations, whether it be what you were saying a second ago about trying to run before you can walk, all of these different categories are exaggerated further by nervous lenders. And surely, as you said, in terms of the down valuations and perhaps what's going to come up at the end of October with Brexit and beyond, depending on what happens with Brexit, that's going to be even more focused upon, isn't it? And the lenders are going to be even more diligent. So if anything, these things are strategies that investors have to get right now in order for them to plan for the next year, 2 years, isn't it?
Definitely. What we had approaching 2 years ago now is the PRA, so the Prudential Regulation Authority, basically took over regulation of buy-to-lets. And they said if you've got 4 or more mortgaged buy-to-let properties, you are classed as a portfolio landlord. And that meant everything you do has to be underwritten. So you're doing transaction X, but that may lead to Y and Z, and that needs checking as well. So that's why when you're remortgaging and you're capital raising, lenders are going to be asking, well, what are you using these funds for? Is it going to trigger further lending? Are you going to use it for deposits? And a lot of lenders are then saying, okay, so you're capital raising on your remortgage, we've agreed the valuation, we're all over those hurdles, but what we now need is the addresses you're going to buy before we offer the mortgage, because we have to tick all of the boxes. We need to know exactly what you're doing. So yeah, there has to be longer term plans in place. You have to kind of work with your mortgage broker. You have to make sure you're ticking the right boxes at the right time. The buy-to-let market has got a lot of focus on it. It was blamed for the downfall in 2008 somewhat, but then I was doing mortgages back then, and I was doing 90% buy-to-let at 100% rental calculation. So basically 10% deposit in, as long as the rent covered the mortgage payment on interest only, we'll give you the money. I mean, that world's long gone. Long gone, but that's where we're coming from, and that's why maybe it's as strict as it is now to avoid the situation we had before, because people have quite short memories, but 2008, whilst it was over a decade ago now, 2008, 2009 was the deepest recession since the 1930s, one of the worst this country's ever had. And we've had some very good years since, and people seem to have forgotten the mess that we got ourselves into. So lenders are going to want to avoid that if Brexit does cause some form of recession.
Of course, absolutely. Now, moving on to our next subject, which was on first-time buyers who are interested in investing in their first property. So not a residential as their first time buyer, but an investment property as their first time buyer. What options or strategies would you suggest for this group?
Yeah, so we work a lot with first-time buyers. It's very popular. Obviously, we're based in the southeast. We're based in Bury St Edmunds, very affluent town, very expensive to buy and get on the property ladder in that town, and particularly in the southeast anywhere. Average house prices well over 300,000 in the southeast, dragging up to the kind of overall national average. So kind of well over 10 times, probably getting close to 12 times the average income. So we get lots of first-time buyers who want to own a property, and a buy-to-let would be a good way for them to go. A first-time buyer, there's often myths that they can't do a buy-to-let. There are lenders that will lend to them, but they will have to fit two sides of affordability and buy-to-let criteria. So they can only borrow what they would be able to borrow on a residential mortgage with the lender who we would place them with. But they would also have to fit the buy-to-let criteria. And typically, there are some lenders that would consider salaries below this, but typically they would need at least 25,000 as an income to tick that lender's criteria, and they're likely to be bound to 4 to 4.5 times their income if they've got no dependents and no debt. but a background affordability calculation would happen as well. So, and you're looking at a 25% deposit. So if you're earning well and you're in an affluent area, I guess, and you want to buy in a cheaper area where properties are sub 100,000, you've got a 25 grand deposit, typically everything's going to work out. And we do a lot of that. We do a lot of that. Lenders are very wary of you buying very locally to yourself at an amount where it could be deemed that they're letting you do what's called a backdoor buy-to-let, which is you're getting you're getting a buy-to-let mortgage to live in the property to try and circumnavigate the affordability, and hence that's why they put their residential affordability into the criteria as well, to stop people going, well, I can't afford a 4-bedroom, I need a 4-bedroom, but I've got the deposit, let's buy it as a buy-to-let and we'll move into it. What people tend to forget is it's 2019, not the year 2000. Everything's on a computer and they can check the council tax log very, very easily, and people get found out and caught very, very quickly for doing, let's just call them very naughty things nowadays. So one of the things that we work with people on first-time buyers is to look at the best way to maximise the income and get onto a property ladder. And a lot of people won't want to do this strategy. They won't. They'll want a true buy-to-let. But what we work with people on is actually looking to get a residential property. So this will mean that you'll only, subject to your credit score and affordability, only need to put down a 5% deposit. Okay, you'll still be tied to around about 4.5 times your income. So we would recommend you buy the biggest property you can in the area that you'd want to live. And then we would say you obviously live in the property, it becomes your home, but if you can buy a 3 or a 4-bedroom property, maybe in a cheaper area, but a bigger property, and then let the rooms out on a kind of lodger basis as a live-in landlord. And there's a couple of reasons for this. If you buy a property and you're going to live in it, under current legislation, you'll get stamp duty relief up to £300,000. You won't pay any stamp duty as a first-time buyer. As a first-time buyer buying a buy-to-let you're not going to live in, obviously you won't pay the additional 3% because it's not a second home, but you won't get the 0% relief under current legislation. So there's a stamp duty saving to be had there. There's a much smaller deposit that you can put into the property. You obviously need to have the mortgage on a repayment mortgage, not an interest only, but you can stretch that out to 35 plus years, with some lenders up to 40 years to keep the payments down. Interest rates are likely to be very similar at 95% to what you can get a 75% buy-to-let first-time buyer rate for. So they're going to be very, very similar, maybe a little bit more expensive, but not a great deal. But the really big thing is there's a £7,500 tax-free lodger allowance under current legislation that means that from that income you can have £7,500 tax-free, which in effect takes your 12,500 up to 20,000 that's tax-free for the year. And that can be a chunk of money. You know, you've got to, in your buy-to-let, you're going to be taxed on it, and very soon you're going to be taxed against the rent, not the profit. So this is a very tax-efficient way under, and I keep saying it, under current legislation. It's always subject to change. But for a first-time buyer to get on the property ladder, what that then allows you to do, in my mind, is I would, if I was single in my early to mid-20s doing this, I'd rent to people I wanted to live with, obviously, be that friends or people of similar kind of interest to myself. So actually it's a nice household to live in. But it also then means that you're a first time, or you're a property owner, which then opens up the market when you want to buy a buy-to-let, and will mean that you'll pay potentially lower interest rates as well. So Brilliant. It's a good strategy in my mind. It's something that I think a lot of people should get involved in and be and be kind of considering as a first-time buyer. And even first-time buyers who don't want to get into property should, if they're single with no dependents, buy as big as you can. But utilise that stamp duty allowance now and rent the rooms. You know, even if you only do it for a couple of years, because there could be income there. And as a living landlord, it's a lot easier to manage those tenants and keep them under control and all of that.
Absolutely. So lots of really good advantages, just to summarise that point. Number one, the much lower deposit compared to buy-to-let mortgages with what your residential mortgage offers. Number two, the stamp duty relief, of course, first-time buyers, which is very much the case with your residential. One of the biggest ones for me, as you said, is the tax relief on your income. You know, that it's incredible the amount of, as you said, £7,500 is a lot of money that you are receiving tax-free compared to if you received £7,500 of buy-to-let. And of course, as you said, the stepping stone to future property investment. So that's really, really good advice. So next thing I was going to ask you is about the here and now. Go on, sorry, go on.
I was going to say, I don't think that just applies to first-time buyers either. I would say if you own a bigger house, a 4 or 5 bedroom house, you really should be considering renting one of the rooms out. If having someone within your property is going to be appropriate, of course. If you've got young children and all that, it might not be. But utilising that tax-free allowance and actually turning your home into an income-generating asset is something that I'd definitely consider. Especially, I mean, if you live in somewhere, I use Cambridge as it's close to us, for example, a university town, you've got a room you could let to a student at a university doing a PhD or a master's or something like that, so a bit older than your kind of 18-year-old student. That could be a fantastic earner for people, and I think there's opportunities in property that people need to consider that maybe aren't the typical things that are often talked about.
Absolutely. Excuse me, I'm just going to talk to Marie about my latest income strategy.
That's it, moving out.
Absolutely. So, next question. Is now a good time for investment?
We get asked this a lot, and I think as long as you're doing your due diligence on the properties that you're looking to buy, I think any time's a good time for property investment. If you look at what the UK market has done since the 1950s, so the end of the Second World War really, every decade, 50 to 60, 60 to 70, so on, average property prices in the UK have doubled. So that may be a little bit challenging from 2010 to 2020, but they've still gone up significantly. And the reason I say that's challenging is that there are a level where the doubling of the average is going, incomes just can't keep up with that. And they're definitely not going to keep up with a 2020 to 2030 doubling. That would make the average price in the UK over 600,000, meaning if you're earning under 100 grand, forget it, you're not buying a 2-bedroom terrace in Rochdale kind of thing. So it's, if you take a long-term view on property, then it's always a good time to buy. If you're looking for quick wins, then you need to make sure you're buying very, very diligently. You're not overpaying for properties, and maybe that means you walk away from deals that just don't stack up. But there's deals out there. We're still working with a lot of investors. I would say the investors are busier that we're working with than the non-investors, so the home movers, the upsizers, all of those are very cautious at the moment. They seem to be less brave, should we say, to take a jump whilst we're still trying to sort Brexit out, whereas the investors that are a bit more seasoned and have seen some cycles and are involved are looking for opportunities for sure, and they'll always be out there. There's always properties that need improving. There's always properties that will rent well. There's always demand in certain areas. it is looking out for those things. It's looking out for the economic changes in the areas. It's watching wider what maybe Brexit's doing. So, for example, if you've watched the news and you see in Wales where they're closing the car plants and things like that, that's going to take a lot of money out of that economy. That's probably not an area that's going to be as kind of popular for people to invest. But actually, if that drives prices down in the short term, if you take a long-term view on that, that might actually make that place a very interesting place to invest in if prices do drop 20-25% because of the economic backwards multiplier effect of a kind of 7,000 to 10,000 people losing their job in a small town. So there's considerations, but property investing is not without risk for sure. We see a lot of bank statements, shall I say. A lot of people do very, very well from it, but you have to kind of take the wider view that a lot of people do have voids. They do have tenants that don't pay them, or they do overpay for properties. I mean, if you watch people like Grant Cardone, for example, he'll regularly say you'll never pay too little for a property, because any property you want to buy, everyone will want to buy, and you'll have to pay too much for it. But then you need to hold it until what you paid for it isn't too much. So it depends on your view. It depends on your attitude to risk. But any time's a good time to buy if you've got a long-term view. The reality is prices may drop, or values may drop slightly in the short term. There is that risk. But in the long-term history shows that they're going to continue rising for sure.
Absolutely. And I think in terms of what you've said there, just to summarize, the short term, from what we've said about the down valuations, from what we've said about lending criteria getting stricter, from what we've said about, or what we're going to discuss in a minute about Brexit, short-term wins, as you said, are more difficult to come by at the moment. But all of what we've just said, and like you said, the home movers and the upsizers are very cautious at the moment, means that there's not as many people looking to buy, and that creates opportunity for investors. And therefore, just like you said, if you have an investor who's willing to think about the long-term prospects, you actually could have a very lucrative opportunity to invest now and wait until later. Yes, the short term is going to be difficult for all the reasons that we've said, but it creates plenty of opportunity for you to create something that for your future could look very, very bright. So I appreciate that.
Yeah, I mean, I've got an investor I've been working with since around about 2007, was buying quite heavily in 2007. Most of those properties went into negative equity, now worth a lot more than the debt outstanding on them. Probably went for a couple of year period thinking, what have I done here? But held the properties, paid the mortgages with the rent, maybe at times had to top the rent up. Obviously, interest rates dropped significantly, which then helped and kind of equalised that problem for them. But they've held those properties for over a decade now, and they're probably 30 or 40% up on the purchase price of the last peak, which was 2007. I think the stats are starting to show that the peak was autumn 2017, so around about a decade after. To say we're on the downward hill would be wrong, but we are within an adjustment period for sure. Most lenders are indexing at about 5% down on purchase price of 2017 is what they're saying the values are. So not a collapse. And I say most lenders because some lenders are also indexing up, which just confuses everyone. But again, there's opportunities there when we're looking at product transfers and things like that. So
sure. Interesting. And coming on to the biggest subject of not only tonight but of history, it seems.
Yes.
What is the current situation that you're finding that Brexit is having on the market?
Well, I think we've touched on it already, that there's an overriding nervousness because of that, we are seeing an increase in available property. So Rightmove kind of report that available stock on their site is up for sure. Year on year, definitely it is up. There's a lot more available. Supply and demand economics mean that that's putting price pressure on, because before you go back 2 or 3 years, early 2017, for example, you'd have 1 2-bedroom terrace and 7 people wanting to buy it. Although Rightmove stats actually said 11 buyers for every property in 2017, which really drove the prices quite hard. But now you've got maybe 3 or 4 2-bedroom terraces and maybe 2 people looking to buy them at the moment. So that's putting a bit of price pressure. You're seeing offers go in much lower than asking prices. You're seeing estate agents do their usual "we need stock," so they're valuing it at what the vendor wants to hear, not what's achievable in the market, and then try and batter the vendor down over a 20-week contract to the price that it should be. I mean, that's estate agency. There's a lot of price pressure for sure, based on the surveyor comments that we've had. The other thing to look at is some of the things that, well, this time next week we will know, I believe, who our new Prime Minister is, and what a choice we have. Well, we don't have the choice unless you're a Conservative member, but the choice will be made for us. And a lot of what's being talked about is property-related tax and stamp duty in particular. So in the last 2 weeks, we've had Boris Johnson say, we'll wipe out all stamp duty for everyone up to 500,000. So just putting that out there has made everyone go, no, we'll just wait a couple of months, shall we? We don't particularly want a stamp duty bill if we don't have to have one. And then last couple of days, there's been an article from AAT have recommended and been advising him on moving stamp duty from the buyer to the seller, which is a very interesting concept. And I think one that they will push, because if you look at a certain transaction, you can keep first-time buyers stamp duty free. So I was discussing this with one of my colleagues, Lucinda, earlier, that if they move it to the seller, they'll increase revenue from it. And someone hasn't typically got to come up with the cash to pay it, because it will come from the sale proceeds. So it will feel less painful. But if you imagine a first-time buyer buying an empty property, there's no stamp duty in that transaction. Or a first-time buyer buying a property and that person is buying an empty property on, there's only 1 stamp duty in that transaction. Whereas if you put it onto the seller, what you have is the first-time buyer buys a property, it's empty, there's stamp duty, or the seller is buying on, the seller pays stamp duty, and the one they're buying, which is empty, pays stamp duty as well. So it will really drive up revenue, and I can see them doing this. I don't know what it will do to the market, because it is a big change in taxation, especially for people that paid large amounts of stamp duty on the way into the property. Yeah. They may not be so happy having to pay it on the way out as well.
I'm sure.
So, yeah, that's a really, really hot topic. Brexit overall is very interesting. I think this is just my own observation, and it's an observation that I've been wrong on numerous times, but it looks like we're heading for a no-deal Brexit. There doesn't actually seem to be any solution that is going to get enough votes in Parliament. It's too divided. And the last kind of article I was reading earlier today was a suggestion from Andrea Leadstone about how Boris Johnson is actually going to do this no deal, which is he'll suspend Parliament the last 2 weeks of October, and then when they return on the 3rd of November, because he won't be able to have the confidence of Parliament, who will automatically call a general election having delivered Brexit, and that he wants to do that with Jeremy Corbyn in office because he feels that at the moment the Labour Party are an easy target maybe, and having delivered Brexit at that point, the Conservatives would feel they'd get the votes. All of this is not good for our industry at the moment, because all it does is make people go, let's just wait.
Absolutely.
And actually, the let's just wait causes the problems.
Yeah.
So people just got on with their lives and ignored Sky News and BBC News and what's going on in Westminster. Actually, the economy would be doing even better. But if we look at what's out there, generally, Brexit doesn't seem to have had an overriding issue at the moment. The employment's at its highest ever. Wage growth is really, really strong in real terms now. All of this is being independently reported over the last couple of months. So the economy is in a strong position. Financial services is much stronger regulated and in a much stronger position than it was in 2007, 2008. So you won't have banks collapse like they used to because of capital adequacy legislation. To explain what that is, basically every pound they lend, depending on the loan to value, they could have to put £2 in a bank to make sure they've got the debt in case it's defaulted against. So yeah, it's just the uncertainty. No one knows the answers. I wish I did. I'm sure you wish you did, and everyone's thinking the same. We're not far off, I would think, having a kind of resolution to it now. It's looking like a no-deal Brexit would be my prediction, and that goes back to a lot of what the banks are planning for. So we'll see. We'll see. But the uncertainty of it all is just making people wait. That's the long and the short of it.
Absolutely. And I suppose, again, that uncertainty, as you said, not only, as we said a second ago, means that, like you said, everyone's waiting and everyone's planning to see what the new legislations are, Conservative government, etc. But again, it offers opportunity for those who are keen to look at the long term and who are keen to take advantage of the uncertainty by looking into the stock that's available and looking for ways of paying a low purchase price because of that uncertainty, and then waiting 5, maybe 10 years to come out of it. So very, very interesting. And well, we've got 4 months, 5 months left to see. So we'll have to see what happens. But for now, Michael, I really appreciate 3 months now. Yeah. So but everything that you've discussed tonight, I really, really appreciate your time. And we do have time also to talk about your new book, which is out in the last 2 weeks. And I'm sure that people listening tonight, having heard all the expertise you have to offer, would be really, really interested in where they can add to their knowledge of finance with your book. So let's talk about it. So it's called The Property Investors Finance Manifesto. Give us a 30-second summary of what it's all about.
Of course, yeah. So the kind of ethos behind the book is to try and get rid of some of the myths that we come across in the marketplace. Social media is amazing for misinformation, not just in the political sphere, but particularly in the buy-to-let lending sphere. Some of the things I see on Facebook just are incredible that people are being told by unqualified individuals. A lot of people do finance courses, creative finance courses, and pay thousands, sometimes tens of thousands to attend these courses. So the idea of the book, it's on Amazon, it's exclusive to Amazon. We've done a deal with them to keep the price at $11.97, and it is almost like a textbook for the property investor, very much specifically looking at financing and different financing methods and creative financing methods in there. As I said earlier, for more experienced investors, but we don't kind of hype anything up. We've got nothing to sell other than the book, of course. So there's no kind of add-on course or anything like this. We're going to try and upsell you, so that there's no hype in the book. It's just factual information And I'd recommend anyone who is involved in buy-to-let or even looking to get into buy-to-let, read this book first, especially before you go and commit to courses of any sort, at any kind of cost, because it will give you the foundation information that you need to be able to sit in some of these courses. And I'm just going off stuff that I've read off social media, so I'm not talking about any particular provider or anything like that. But people do seem to be being taught stuff that maybe is a decade out of date by people who maybe haven't bought properties too regularly or aren't able to do what's actually being taught. In theory, it should work. In practice, no lender is going to let you do it. So what the book tells you is what you can actually transact in 2019, what you can actually do, and what situation you need to be in to do that. And we talk about a lot about how finance works, different types of mortgages, a bit about the regulation. That chapter's awesome. So it is like a textbook.
Sure.
We were talking earlier, it's not Harry Potter. It's not going to be a kind of a novel read. It is a textbook for investors on finance.
Brilliant. That's a really great summary. And I'm sure, as I said, that people listening tonight will have been able to gather from your experience that it would be well worth a read in order to help them in your property journey. And just to touch upon it, of course, as we said earlier, you're the owner and managing director of Mortgage Republic, mortgage brokering firm based in Suffolk. How could people get in touch if they want some advice on a particular mortgage issue that they want to do through yourself?
Yeah, so the best two mediums to get in touch with us are either via our website, mortgagerepublic.co.uk. All of our contact information's on there, our telephone numbers. There's even a live chat function on there that's kind of managed most of the time, so you can kind of chat to us live. We've got a Facebook page that's quite active. There's lots of buy-to-let and other articles that I write and publish on there, so there's a lot of information for investors on our Facebook page that's just there for free. I'd recommend kind of giving us a like on Facebook to keep up to date with that, and again, you can message us on Facebook, and yeah, we're more than happy to help people along their journey. We look at lifetime relationships with investors, have a lifetime fee structure as a mortgage broker. So we don't believe that we should be charging our clients every time we're operating with them, every time working with them, and we build these long-term relationships. And hence I've worked with clients for over 10 years. Mortgage Republic hasn't been running for that long now. It's been around for just over 3 years, but these clients have kind of followed me to work with me. So yes, we've helped people grow from having just their home to having very large, very successful portfolios.
Brilliant. No, that's really great, Michael, and great to be able to offer people not only with your book, but also your services as well. So, Michael, it gives me the opportunity to say thank you so much for joining us tonight. Really appreciate your time, really appreciate all your knowledge, and really interesting debate on the situation within finance and lending at the moment. Have a wonderful evening. Good luck with the book, and we'll speak to you very, very soon.
Thank you very much for having me on. It's been a pleasure to chat with you.
Thanks, Michael. All the best. Take care.
Okay, see you later.
Thank you so much for watching the 2310 video cast today, and I really hope you enjoyed it. For more of these or more information about property investment in general, follow me, Khalid Maidan, on Facebook or khalid.maidan.property on Instagram. Have an awesome day. See you soon.